Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. This week's episode is a conversation I had on Clubhouse with Braughm Ricke, CEO and founder of Aduro Advisors, a Denver, Colorado-based fund administration platform. Prior to starting Aduro, Braughm was the founding CFO of True Ventures, one of the preeminent Valley-based venture capital funds. Braughm decided to launch Aduro as a tech-enabled fund administrator that has grown to over 300 plus firms and over 30 billion in assets under administration. His team works with some of the most established fund managers like Lowercase Capital, Homebrew and Craft Ventures. On today's show, we talk about the rise of emerging managers and the industry supporting them. Braughm discusses why the investment side of venture capital has lacked innovation until recently, and how the emerging managers are leveraging platforms like Aduro, Carta, and Angellist to remove some of the headaches of running a venture fund. We asked Braughm about the popularity of rolling funds, SPVs, and syndicates, and how it has allowed emerging managers to compete with the more established venture capital players, and whether or not an institutional fund can ever be run on Angellist. Finally, we asked Braughm to explain what makes a great emerging manager, and how new funds can learn from Aduro on how to effectively and efficiently manage a venture capital firm with institutional LPs. Now let's get into this week's chat with Braughm Ricke from Aduro Advisors. Thanks for joining us today, Braughm.
Yeah, Matt, thanks so much for having me.
So as I mentioned on today's show, we're going to be talking about the rise of emerging managers and the industry supporting them. So I'd like to kick things off and hear about how you went from being a CFO at one of the leading Valley VC funds, True Ventures, to wanting to keep other emerging managers in venture capital and private equity and helping them with fund admin.
Yeah, no, that's a great question. So, it was kind of an interesting, move for me, obviously, kind of being CFO of a very successful firm. And, I kind of look back to, when I joined True, it was literally partners and a presentation, right? And so just kind of highlighting the desire to take that entrepreneurial approach. And, 6+ years in, started to recognize that I was providing more and more advice to, new managers, emerging managers at that time, at the very forefront of the emerging manager trend. And started to recognize the fact that, this was potentially going to be the next trend. When we started True Ventures, the shift in venture was that kind of next generation of platform groups. So True, Union Square, Felicis, you name it. And, started to recognize that there was a new trend emerging, kind of in that single or dual member manager firm spinning out and, creating a group of their own. And really started to think that was going to be a growing trend. Obviously, that trend played out quite significantly, and we've been able to take advantage of that in our business. But yeah, that was kind of the thought process behind why deciding to start this firm.
So when the people came to you and asked you some of the questions about like emerging manager questions and running a fund and stuff like that, were those the same questions that you're still getting asked today?
Yeah, a lot of it is very much the same because, as you can imagine, almost all of our clients have done investing, right? So they've either done investing in the form of angel investing, or they've done investing while at a larger firm. But very few, if any, have necessarily run a firm of their own. And so all of that infrastructure that goes into play when running a firm of your own is very much an unknown to a lot of these people. And so we still see that today as this trend continues to gain steam. We just see that more and more.
Well, that exact moment happened to me in around 2017, where I woke up one day as an angel investor, and then someone told me I should think about running a venture fund. And thank God there are people like you out there to actually guide, emerging managers like myself at Ripple through this complicated jungle. But maybe for the audience out there, why don't you explain what exactly fund administration means? Because it's very different than just investing as an angel or running a syndicate. But what is fund administration in your eyes?
Yeah, fund administration in my eyes is really the infrastructure behind running the firm. And what that entails is everything from the accounting to the financials to thinking about valuation from a audit perspective. Not necessarily what I think this company is worth, but what can I say this company is worth on paper and feel comfortable with and get the auditors comfortable with. There's also investor relations. So all of the communication of all of these notifications to your investors and others, and also being able to have a platform to facilitate all of this, right? At the end of the day, the back office component anymore for a venture firm isn't just about the experience. It's not just about the the actual doing of the work. It's also about the having a platform to be able to leverage to do all of that. And that's why, as you mentioned earlier, we kind of took the approach to become more of a tech-enabled service provider as opposed to just a traditional service provider. And so we think that technology really has a large component here, but it's obviously still very based upon experience and based upon the service to your investors.
So it's really about all the unsexy stuff that happens behind the scenes when actually running a fund. Because, as I experienced, the investing is just one part of the journey, but there's so many other things that go into how the sausage is actually made that you guys really help with and nobody really wants to talk about. But it is so fundamental to the success of a venture fund and also how LPs view you behind the scenes on what is not talked about, let's say in TechCrunch or so every day, right?
That's right. Yeah. And that's kind of what I tell people, when they come to me. I basically boil it down to, we'll do all the boring, the unsexy stuff, as you said, and, make it completely, as hands off as possible for you so that you can really go off and do, ultimately what your investors are paying you to do. They're paying you to go out and find amazing investments. They're not paying you to make sure the capital calls are sent correctly, right? That's our job. And so, we really want to enable you to go off and do the fun part.
Right. I mean, the venture capital industry exists as a means to innovation, though. And, the investment side of it has really lacked innovation until recently. Why do you think that is? And what kind of innovation did you think about when you started Aduro to become a tech-enabled fund administrator? And I guess, where do you see it going in the next, some time?
The industry is all about investing in the future and investing in the future of technology, but yet it still seems grounded in, technology that's kind of circa 1999. Even when we started this company in 2012, I took a fresh look at all the technology that was readily available and kind of off the shelf for this industry, and it still had that circa 99 feel. And a lot of it still does today. And so I think that it's just not as interesting of an area for innovation. When you think about venture historically, there were much fewer firms. And so, when you think about starting a company that's dedicated to selling into those firms, the market probably felt, fairly small. Whereas today, we've grown from hundreds of venture firms to literally thousands of venture firms in a very short time span. And so I think that that's driven a lot of the, motivation towards innovation in the industry. My motivation initially was just, I want something that's going to make my team more scalable so that we can just provide the best service possible and, give our clients really, what they need. I always joke and tell people that I built the dream product that I wish I'd had when I was at True Ventures. And that's really kind of what it's become. But I think that the growth in the industry and also the popularity of the industry, right, with all this growth in the emerging manager space, with all the growth in the startup world, there's a lot more attention placed on venture in general. And so I think that's just garnered a lot more attention from companies wanting to sell into this space. And so I think there's a lot of variables at play that are really driving that.
Yeah, it's interesting to hear you say that you built the product you wish you had at True, and the market was much smaller back then when you launched it. But do you ever think that maybe you helped build out the market size for emerging managers by giving them this tech-enabled solution? I know you don't want to take all the credit for it, but you definitely made it a lot easier for firms like us to do it. So you expanded the TAM, as we would say.
I would never take that much credit for it, but I would like to think that I contributed to it for sure.
Well, you work with top tier firms like Craft, Homebrew, and Lowercase Capital. So why have such established firms continue to stick around with Aduro after all these years? And what can new emerging managers learn from Aduro after watching your early success with those clients?
Yeah, that's what's interesting about the space is that, we've really been able to grow and scale with our clients over time, which was obviously always the goal. And we're starting to see, more established managers who have historically done everything in-house. So there's kind of two modes to manage your back office. One is in-house, one is outsourced. In-house is when you hire the entire back office team, your CFO, your controller, your accounting manager, et cetera. And it's very expensive and time consuming, as you can imagine. And I think that a lot of more historical firms who have done that in the past are starting to recognize the value of, an outsourced platform. To leverage the technology, leverage the best practices that we have across, over 300 firms, et cetera. And so we're seeing, more traditional firms kind of catch up to that. And so, there's definitely a major shift in the industry, not just on the emerging manager side of things, but the emerging managers, they went into this never wanting to do that, right? Never wanting to necessarily build out a back office team. And we've got, a fair number of large clients, like Craft, Goodwater, Obvious Ventures, et cetera, who have, internal members of their team, but, you really have to get to a scale, a pretty sizable scale where that starts to make sense. And we've really enabled that, to kind of go back to your last comment, maybe we have enabled a lot of this. We've enabled these firms to grow and scale quite a bit without having to concern themselves with, that back office side of the operation.
Yeah, I mean, that definitely is a big trend that we're seeing more and more of, by way of which you're helping people outsource a lot of the roles, but also with popularity of things like rolling funds and opportunity funds and SPVs and syndicates. And I guess most recently it was SPACs. They've allowed emerging managers to compete with more established venture players than they have ever before. What do you think about all this? And how do you think this will affect sort of LPs' views of emerging managers and how this will kind of grow into a much more dominant industry for people who don't want to be full-time fund managers?
It's definitely going to make a lot of change or create a lot of change on the LP side of things. I think LPs, historically speaking, and we saw this a lot because we obviously have, I have good relationships with a lot of large, more traditional institutional investors, and historically they would add, maybe one new manager relationship a year type of thing. It was very concentrated in terms of their commitment base across managers. And I think the major shift is that LPs in general are getting and will have to get more comfortable, spreading that out more. As you have more and more new managers creating their own firms with very specialized, investment strategies, which I think is fantastic. And I think that very much value, a lot of value in that for the industry. But I think they're going to have to get more comfortable, like I said, making, more new manager selections. And it's going to get harder because obviously, it's very easy to write a, 30, 40, $50 million check to, a Sequoia, an Andreessen or somebody like that. And it's much harder to split that up into, much smaller commitments and find, 20 new managers or 30 new managers to place that in. So it's a lot more work for the investors, for the LPs, but I think ultimately it's better for the industry as a whole.
Yeah, so a lot of people are now getting funded that probably wouldn't have been maybe 10 years ago, which is great for the industry. But when you have a global pandemic, let's say, and it hits the market pretty hard, you often see that LPs retreat back to those established managers when there's so much volatility in the market, as we saw in 2020. So how do you think emerging managers should think about this and play it for the long game and not trying to time the markets?
Yeah, I mean, trying to time the market for fundraising is obviously, near impossible. What I tell everybody is that you're always fundraising, and this was one of the mantras that we held true at True Ventures was, you're literally always fundraising. You're always building those relationships with investors. You're finding, those investors that may come into your next fund or in two funds. So you're always, cultivating those relationships. And so I think it's a constant process. You never want to get into the habit or the cycle where you raise the money and then you just shut off all communications with any new investors because you're focusing on investing, and it's difficult for managers because you really have to balance both of those time commitments. Because I hear a lot of managers saying I can't invest because I'm too busy fundraising or vice versa. And you really have to be able to balance both. And so it's more work on the investor side, but like I said, it's also more work on the GP side as well to really always focus on those relationships. And it's still a relationship game at the end of the day. It's all about finding those investors that will be open to building a relationship with you, be open to investing in you, either in the near term or in the future. But then also, be there for the long haul. You want those investors that are, interested in investing in, not just one fund, but in, 3 or 5 funds, however long you think you're going to be in business. And so you really want those repeat investors if you can.
Yeah, I mean, I can speak firsthand. The time I allocate to fundraising is still as much as it was with my first fund and now with our second fund, because it is a long game and these LPs are not interested in just like taking one meeting and then making a decision. It's about repetition, building relationships, and they could be not interested in your first, second, or maybe third fund, but they could be there with a big check for your fourth fund, which could be 6 years away. Who knows? But it all starts now. And I think also by having a lot of parts of the fund managed with firms like Aduro helps give you a bit more of your time back to focus on fundraising, which is also an added benefit, I think, of the fund administration stuff that your team helps us with, which I'm sure you didn't think about when you started it, but it is an additional benefit for GPs who are, on the fundraising trail all the time.
Yeah, that's right. We really do, like to think that we're able to help our managers balance their time a lot more.
Now, here's an interesting thing I've been thinking about, wondering what your insights are. Do you think one can launch an institutional fund on Angellist or a platform like that?
I think that there's a lot of things that make that difficult. Because of the relationship aspect and because of that long-term relationship building with an investor, I think there's still a lot of hurdles there to do that from an institutional standpoint. I think Angellist is amazing for so many things. And so, for raising pools of capital from individuals, high net worth individuals, et cetera, I think it's fantastic. I think that there's still a lot of hurdles in place to get institutions comfortable with the idea or the concept that, they're going to be committing to a fund through something like Angellist, because it almost runs interference in that relationship in some vein.
I do agree. I mean, I think the SEC has made it relatively easy for accessing private capital in the last several years, especially with their new accredited investor rules in August of last year. So you've got platforms like Republic and other crowdfunding tools, which allow better access to private capital. But I do think it's very one-off for company specific rather than raising large blind pools of capital. I don't think, Blackstone's raising a private equity fund on Angellist in the near future. But how do you think these platforms will impact, I guess, traditional fundraising for emerging managers, going forward?
I think there's definitely a place for these platforms, and there's a lot of platforms being created around this for creating somewhat of a marketplace for managers to be able to raise capital, but also, like I said earlier, for discovery on the investor side, on the LP side. LPs can't rely on just their immediate network of getting access to the best managers in this space, because the best manager, may be, somebody completely unknown. And so I think there's definitely an opportunity for a lot of groups to create some form of marketplace for discovery and for raising. Like I said, there's a number of groups out there, trying to tackle this. And so it'll be interesting to see how that plays out longer term, for both sides of the equation.
Yeah, maybe it's something Aduro could tip their hat into, given that you said you have, a bunch of LP relationships and obviously a bunch of emerging fund managers on the platform. Single sign-on works for both sides. Who knows if there's a marketplace that comes out of it?
Yeah, we're definitely trying to figure that out, and to see how we can do it without the regulatory world in this space is difficult. We obviously don't want to be a broker dealer in any way, shape, or form, and so it's definitely something that we're exploring.
Yeah. What I'm noticing, and even for ourselves with our launch of Ripple Capital, which is our own private capital going out and supporting other emerging managers, is these emerging managers like us are able to last longer in the fundraising journey of a startup because of these new pools of capital available to them through syndicates. So for example, if you're a pre-seed or seed stage fund and your company is now at the series C or D level, you can really get, $5 million checks put together to be participating in those large rounds. I'm kind of wondering if LPs are excited by that, or if it's forcing them to change their strategy by maybe getting into the emerging managers with like a scout check themselves so that they can pick up those pro rata co-investment opportunities as the companies move into the later stage, which I think we're seeing a lot more of as well, which is really interesting.
Yeah, I think that you're going to see a lot more of that. You're going to see a lot more of, especially as you get more and more institutions involved in the space and kind of dipping their toes into the emerging manager space. You're going to hear more and more about, co-investment desires from the LPs, because they're going to be, making that commitment to the emerging manager with the understanding or the expectation that they can get into those, those broader deals, right? For an LP that typically needs to put, like I said earlier, multiple tens of millions of dollars to work in one relationship, that's an interesting way for them to kind of get to that place where if they can make an appropriate size commitment to a smaller emerging manager fund, but then really be able to make outsized commitments to those pro rata checks through SPVs or an opportunity vehicle. If the GP is able to put that together, I think that's very valuable.
Yeah, it sounds like LPs are kind of becoming a hybrid fund, which they have to now to get those scout checks, emerging checks out, but then save large reserves for those large, $50 million checks when the company is doing, a pre-IPO round or something like that. And they're the only ones left with the capital to do it. But they use the relationships from that emerging manager to really build a relationship directly with the company, which is really interesting.
Yeah, that's absolutely right. And then you're also seeing a new class of emerging manager as well, which is the emerging manager on the fund to fund side. And that's very much the strategy and the approach that they're taking is to basically come with a strategy of to say, hey, we can make commitments to these really interesting up and coming managers, but also do direct investing on the side because of what we can access, through those relationships. And so we're seeing a lot more of that as well, which I think is fascinating.
Yeah, it's really exciting for funds like us as well. So I'm excited to see more of that. Venture capital fundraising has always suffered from the 80-20 rule, where 80% of the LP capital has usually gone to the top 20% of VC funds, which kind of puts the venture capital industry in a near oligopoly. So what are your views on this? And how do you think partners like you are helping change this oligopoly from existing with emerging managers?
Yeah. So, like I said earlier, I think that the big shift is obviously coming from the LP side, having to get comfort with being able to, manage a broader set of relationships on their side of things. And we're starting to see that shift and that trend. That 20% of other capital is very much a long tail of, a large number of firms, right? As opposed to that 80% is probably pretty concentrated. And so, we're definitely starting to see a shift there on the investor side, being more comfortable spreading their capital a little thinner across, more relationships. But it's a slow process. By all means, it's definitely a slow process. I think that the way that we're able to, help address that and support it and encourage it is, like I said earlier, just being able to make this almost a turnkey type solution where we can have all of the infrastructure in place and ready to go, so that you don't have to think about that. So it makes it much easier for an individual to actually go out and start a firm of their own, as opposed to historically not being able to. And with the shift in investor mentality, they feel more comfortable and more confident going out and raising a fund of their own. Historically speaking, one of the big hindrances of a junior partner at a large firm going out and starting their own fund was just the fear of never being able to raise capital, because they were really insulated from the communications with the LPs, and so they didn't have those relationships. They weren't really building those relationships, and without those, it was just seemingly impossible to go out and raise capital. And so there's definitely a lot more democratization of the capital base as a whole, and so it's just kind of like I said, encouraging that trend.
Well, I think you also help give confidence to emerging managers to stand on a solid footing when they're going to pitch these LPs, when it comes to guidance on, hey, this is what your reporting infrastructure looks like. This is how you schedule your portfolio's construction and waterfall analysis and a lot of these things that people are new to. And when they get asked by LPs about these questions, they can lean on the Aduro team to help them guide them through that and prepare them for that. At least is what I found. I mean, we still haven't found a solution to calculating the carried interest in waterfalls. Everyone seems to still be doing that on Excel spreadsheet, but hopefully you guys have a plan to solve that soon, right?
That is in the works, 100%. Yeah. No, but you're right. It does give confidence, right? So, when going in and talking to an institutional investor, no matter how small, I think it's great for a manager to be able to say, hey, we're working with Aduro, so, check the box on everything operationally, operational infrastructure, right? So it negates that discussion from the outset. And so, we find a lot more of our clients coming on earlier and earlier in the fundraising process so that they can, include our name in their presentation as they're talking to investors. so that, like I said, they can just automatically check that box and it's just becomes a non-discussion point.
Yeah, I mean, that's definitely what we do. We have the Aduro name plastered on our deck at the end with all the different services that you have helped us with and provide, and it definitely goes a long way. So thank you for that. The traditional VC operating model has traditionally focused on raising capital from investors, generating the deal flow, making that investment, and managing the portfolio, and then hopefully distributing that capital back to investors and repeating that cycle over and over. But with the innovation that's happening in the space, with more outsourced services like Aduro, and building out more of a platform approach, how do you think the new venture funds of the future will look and operate going forward?
There's definitely going to be evolution in terms of how funds operate and how they're managed. Not a significant trend, but one thing that we're starting to hear a little bit more is the concept of an evergreen structure, where if you're able to tap into a set of investors who it's not about getting liquidity back in a set number of years. It's really just about growing that capital base over time. And so wanting to continually reinvest that, not for everybody and not for every type of investor, but we're starting to see a little bit more of it. And so I think in general there will be more innovation. I mean, we've seen some innovation around rolling the concept of rolling funds, of being able to re-up at certain intervals into a fund as opposed to going out and raising a new fund. And so I think that there will be a lot of innovation, just making the fundraising process as streamlined as possible for groups. Kind of going back to our earlier comment about creating marketplace for discovery, right? So I think anything that groups can do to make that process of discovery on both sides of the equation easier is going to be very powerful for everybody involved.
What about transparency and a standardized form of reporting? I mean, this is something that gets me a little frustrated, is that everyone has different metrics for reporting. There's no standard. Everyone says IRR, MOIC, TVPI, DPI. You can throw out any acronym you want, but there's really no standard. I mean, for me, IRR is a gamification of timing. It's used in the real estate industry and maybe private equity, but it feels like people kind of lean to the best metrics when they want to ask people for money. So what do you think about that? And why haven't we seen some form of standardization? I know people are pushing for it, but what are your thoughts on that?
Yeah, I mean, investors, especially on the large institution side, are definitely pushing for standardization, where they can. I mean, there's the ILPA requirements across the board, many of which are pretty extreme, but, there's definitely an attempt there. What I always tell people is, at the end of the day, the standardization is effectively what metric will your potential investors pay attention to. And I think that that's ultimately the standardization that everybody should kind of, rely on. Net IRR is, of course, one of those, but you're right. It is a little bit, it can be gamed from a timing perspective. It can be gamed a little bit from a, carrying value perspective. There's definitely the wanting to be conservative on valuation, but also the desire to be a little bit more aggressive when you can, for the sake of making that, net IRR look better. At the end of the day, what do investors, ultimately care about is DPI, which is distributed versus paid in capital. How much have you returned to me over what I gave you? That's ultimately the gold standard metric. It's hard because DPI is one of the hardest things to get to a number of significance, especially in a short amount of time. These are long-term investments. Most of these companies, you're not going to see returns for, if you're investing at the early stage, for 5 to 7 or more years. And so, it's definitely hard to rely on that from the GP side of things, hence the IRR preference.
Yeah, I think it's also depending on the timing of the reporting. So like DPI doesn't really happen until years 3, 4, and 5 when you're in the harvesting years, or even later. In the early days, it's really about MOIC, maybe IRR, but it's not really real IRR because you haven't distributed any capital or you haven't realized any of those gains. So it's kind of a combination depending on the timing. An LP of ours who invested in another company, but it just was asking for my opinion, found out that he invested at a $20 million valuation a year ago, and they just raised money at a $200 million valuation. I was like, wow, that's amazing. Congratulations. He's like, yeah, it's amazing. I'm up, probably 10x or something. I said, well, you might want to look at the dilution and see exactly where things shake out. If you asked for some of the cap table, I'll help review it with you. And sure enough, he came back and he said, yeah, I'm up 2 times. And it was deflating, but it shows why people are misguided when they look at the valuation they wrote their first check at and what the current valuation is of the company today, and never ever take into account dilution, ownership, and all those different things that happen in between, those time periods. And I think that's really where a lot of the message is lost. Wouldn't you agree?
Yeah, absolutely. You look, it's so easy to look at the surface numbers and think, just like you said, it's a 10x, right? But there are so many variables at play. There's the dilution. There's dilution in between the rounds. Has the company issued more options and diluted everybody at the end of the day, right? And that's probably how they got to a 2x versus a 10x between that last round and this current one. Or maybe there were rounds in between, or there were bridge notes or safe notes written into the round that converted. So there's so many variables kind of behind the scenes that I think are lost in that surface messaging. And so kind of boiling it down to the MOIC or a gross IRR on the company by company basis is definitely relevant. It's definitely helpful. But like I said, I think the ultimate number for people to be fundraising off of is net IRR. The ultimate number of success at the end of the day is DPI.
Yeah, 100% agree. And I mean, for us, what we've done at Ripple is we've actually built a full fund model with like realistic dilution expectations for all of our company. And then we demonstrate to LPs, how do we get to 3x DPI based on that, final ownership in the business, based on our first check and the checks we have reserved for pro rata, and what that will look like, and on a total enterprise value of the fund based on our average ownership across those companies. And, we try to be as conservative as possible, but it works out to a really good understanding of your own fund and how LPs can view a realistic outcome that doesn't have this, 10x on paper, but really 2x is what you get paid out of at the end of the day situation. So Braughm, you've got a couple books that you'd like to bring up here. Any of your favorites that you suggest the audience gives a read to?
Yeah, one of my favorites recently is The Obstacle is the Way. Really, really enjoyed the basis of that book, and I feel like, it's a really good approach, especially for entrepreneurs in general, to really take a viewpoint of, hurdles in life as an opportunity, and really kind of, turning those around. I think that was, the message that really came out of that book was amazing. The next one is The Outsiders. This is I think this is one of Warren Buffett's favorites.
An oldie but a goodie.
Yeah, it's definitely an oldie but a goodie. It's just really interesting to read these stories of, and yeah, I mean, these are stories of CEOs and managers from ages past, but I think that the concept of how they thought about things is still true today. Just kind of being able to sit back and look at things differently, and not just feeling like you have to do things like everybody else. At the end of the day, one of my favorite fun reads lately was Ready Player 2. Ready Player 1 was a book that I could not put down, nor could my teenagers. Ready Player 2, I had mixed hopes of whether or not it would be good, and in all honesty, I couldn't put that one down either. I don't know how much of that genre you read.
I'm definitely interested. I mean, I've got my Oculus ready to go all the time. So living in that world on a bad day or a good day, I guess it depends. But those are amazing book suggestions. Thanks so much for bringing those up. And thanks so much for joining us in the tank today, Braughm, to discuss the rise of emerging managers and the industry supporting them with Braughm Ricke from Aduro Advisors. Thanks so much, everyone, for joining us.
Yeah, Matt, thank you so much for having me.
Thanks for listening. As always, if you enjoyed this episode, please leave a review on Apple, Spotify, or wherever you listen to your podcast. And make sure to give me a follow on Twitter or Clubhouse if you want to be in the audience and ask a question on our next Tank Talk. Till next time.